China is quietly dumping the US dollar, and it could shake the global economy to its core. In fact, over 60% of China's foreign exchange reserves are now shifting away from the dollar, signaling a major shift in economic power. This move could devalue the dollar, spike inflation, and threaten your savings and investments. If you want to understand how this could impact your financial future and what you can do about it, you're in the right place. Stay tuned, because what you're about to learn could change the way you see the world's economy. Make sure to like and subscribe so you don't miss out on vital updates. Now, let me show you why this is so urgent and what you need to know before getting started. Today, we're exploring why China's move to reduce its holdings of the US dollar is a much bigger deal than most people realize. This isn't just about currency trading. It's about the future of global economic power and how it could impact your finances. As China shifts its reserves away from the dollar, it signals a potential shift in the world's financial order, which could lead to a weaker dollar, rising inflation, and changes in investment opportunities worldwide. Right now, in the context of the U.S. economy, this move raises important questions. Could it accelerate inflation? What does it mean for your savings, retirement plans, or investments? For everyday individuals, understanding these shifts can help you make better financial decisions and prepare for possible economic changes ahead. This video is designed for viewers with a basic to intermediate understanding of economics. Those who want to grasp how international currency shifts can impact their personal finances and the economy at large. By the end, you'll have a clearer picture of why China's actions matter, how they could influence the dollar's strength, and what that means for your financial future. You'll be better equipped to recognize the signs of economic change and make informed decisions in a rapidly evolving landscape. But to make smart decisions, you first need to understand the economic landscape we're dealing with. Recently, China has been quietly reducing its holdings of US dollars, a move that signals more than just a shift in reserves. It could reshape the entire global economic landscape. According to data from the Federal Reserve, China's U.S. Treasury holdings have decreased by over 20% in the past 2 years, now standing at their lowest levels since 2017. This reduction reflects growing concerns about the stability of the dollar amid rising inflation and fluctuating interest rates. Inflation in the U.S. has soared to 6.5% annually, according to the Bureau of Labor Statistics, prompting the Federal Reserve to hike interest rates multiple times to curb price increases. Higher interest rates make holding dollar-denominated assets more expensive and less attractive, encouraging foreign nations like China to diversify their reserves. At the same time, rising mortgage rates and home prices are affecting the housing market, signaling a potential slowdown that could impact global financial stability. These shifts are interconnected. As the dollar weakens, the cost of imports rises, fueling inflation further. Conversely, a declining dollar could make U.S. exports more competitive, but also signal underlying vulnerabilities in the economy. For investors, these developments highlight the importance of diversification and risk awareness amid uncertain market cycles and tax policies that may change in response to economic pressures. With that context in mind, let's break down the strategy you can actually apply. China is gradually reducing its holdings of U.S. dollars, and this move could have big effects on the global economy. To understand why, let's break down what's happening. Countries like China keep their money in different forms, called reserves, to protect their economies and manage their finances. One common way is by buying assets like U.S. Treasury bonds, which are basically loans to the U.S. government. When China buys these bonds, they're investing in U.S. debt and holding dollars as part of their reserves. Now, if China starts selling off these bonds in dollars, they're essentially getting rid of their U.S. assets. This process is called dumping or selling off reserves. The reason they're doing this is because they're worried about the value of the dollar falling or becoming less stable. When many countries do this at once, it can cause the dollar's value to drop. Here's what happens next. A weaker dollar can make U.S. exports cheaper for other countries, helping American businesses sell more abroad. But it also means the dollar is less strong worldwide, which can lead to higher prices for imported goods in many countries. For China, reducing dollar holdings is part of a strategy to diversify their reserves into other currencies or assets, reducing reliance on the US dollar and protecting their economy from currency fluctuations. This process involves careful planning and timing, as selling large amounts of US assets can influence currency markets and global trade. It's a strategic move that can shift economic power and investor confidence worldwide. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine you're considering buying a home in the United States valued at $300,000. You plan to put down 20%, which is $60,000, and take out a mortgage for the remaining $240,000. Using current rates around 4.5%, your monthly mortgage payment, covering principal and interest, would be approximately $1,216, according to mortgagecalculator.org. Now, let's say the seller accepts your offer and you sign the deal. Over a 30-year loan, you'll pay roughly $438,000 in total interest, making your grand total paid around $738,000. But here's where things get interesting if the dollar starts weakening due to China reducing its dollar reserves. The cost of borrowing could rise, pushing your interest rate up to 5% or more, increasing your monthly payment to around $1,288. That might seem small monthly, but over the life of the loan, you'd pay an additional $50,000 in interest. Moreover, a weaker dollar can cause inflation, making everyday goods and services more expensive. If your income doesn't rise accordingly, your purchasing power diminishes. This scenario illustrates how a shift in global currency reserves can ripple through individual finances, raising borrowing costs, increasing living expenses, and impacting investment returns. This looks great, but only if you avoid the common traps that ruin deals like this. Imagine a scenario where China begins selling off its US dollar reserves. While it might sound like just a shift in foreign policy, it's actually a move that could ripple through global markets and impact your financial life. But understanding the bigger picture is key to avoiding costly mistakes. First, many people overlook how currency fluctuations can affect borrowing costs. If the dollar weakens, interest rates tend to rise, making loans and mortgages more expensive. A common mistake is ignoring these potential shifts when planning big financial decisions, like buying a home or refinancing. Without proper awareness, you might lock in a rate that's about to become less favorable. Second, some assume that global economic changes won't touch their day-to-day expenses. But as the dollar weakens, imported goods and everyday products can become pricier. Overpaying for essentials or failing to adjust budgets accordingly can hurt your savings and financial stability. Third, rushing into investments without understanding currency risks is another common error. People often chase high returns without considering how currency devaluation might erode those gains over time. This oversight can turn a seemingly smart investment into a loss. Finally, skipping due diligence on economic news and policy shifts can leave you blindsided. Staying informed about global movements, like China's dollar reserves reduction, is crucial to making proactive, not reactive, financial choices. To avoid those mistakes, here are the best tools and resources available right now. Why China's dumping the dollar is a bigger deal than you think. Recently, China has been reducing its holdings of US dollars, selling off assets like treasury bonds. This move could weaken the dollar's value globally, leading to higher interest rates and increased costs for everyday expenses. For individuals, understanding the shift is crucial to protect your finances. To stay ahead, start by using trusted financial websites and apps that help you make informed decisions. For example, Investopedia offers clear explanations of economic concepts, helping you understand how currency changes impact your money. You can visit www.investopedia.com for articles and tutorials. Credit Karma provides free credit scores and financial insights, so you can monitor your financial health and adjust your plans accordingly. Check it out at www.creditkarma.com. Redfin is a real estate platform that shows market trends, helping you see how rising interest rates might affect property prices or mortgage options. Find it at www.redfin.com. Finally, CNBC's Market News app delivers real-time updates on global economic shifts, including currency and stock market movements, keeping you informed and ready to act. Now that you've got the tools, let's talk about the first thing you can do today to get started. Imagine a world where the value of your money is more secure and your financial future feels more in your control. Right now, China's move to reduce its dollar holdings is a sign that global markets are shifting, and it could impact your finances more than you realize. But you don't have to feel overwhelmed or powerless. A simple first step is to check your credit report today. It might seem small, but understanding your credit score and financial standing is the foundation for making smarter decisions, whether it's saving, investing, or preparing for future expenses. By taking a few minutes to review your credit, you unlock clarity about where you stand and what areas you can improve. This knowledge empowers you to navigate changing economic conditions confidently. Starting with this small step creates momentum. It's easy, it's doable, and it puts you in control. From here, you can explore other actions like tracking your expenses, downloading a finance app, or even simulating investment options. Each move builds your financial resilience and prepares you for the long term. Remember, every success story begins with that initial step. Taking action today sets the stage for a more secure tomorrow. So, let's commit to starting small, because small steps today lead to big changes tomorrow. When you stay consistent, you'll find yourself better prepared to face the shifts in the global economy and achieve your financial goals. Imagine yourself 10, 15, even 30 years from now. You've built a solid financial foundation, not overnight, but through consistent, deliberate actions over time. Maybe by 2035, you own 5 cash-flowing properties that generate enough passive income to cover your living expenses. Or perhaps your savings have grown exponentially, thanks to steady contributions and smart investments, allowing you to pursue your dreams without financial stress. Now consider the bigger picture. The recent shifts in China's reserve holdings and the potential decline of the dollar signal that markets are changing, but your long-term strategy remains your strongest asset. Small, consistent steps today, tracking your spending, investing regularly, and staying informed, compound into powerful results over decades. The key isn't to chase quick gains, but to stay committed to your plan, regardless of market volatility. Remember, real wealth isn't built in a day. It's the result of patience, discipline, and a clear focus on your goals. As you look ahead, think about where you want to be in 10, 20, or even 30 years. Visualize the stability and freedom that come from steady growth and perseverance. And now that you see what's possible, here's how we wrap this up and take action. Start today. Set your goals, create your plan, and commit to consistency. Because the true power lies in what you do today to shape your tomorrow. So, in summary, China's decision to dump the dollar isn't just a small shift. It's a move that could reshape global markets and impact your financial future in ways we're just beginning to understand. This signals a shift in how countries are managing their reserves, and it could lead to increased volatility or even new opportunities for savvy investors. Thanks so much for sticking with me today. You're making real progress toward understanding the big picture and how these global moves affect your money. Remember, staying informed and adaptable is key to securing your financial freedom. If you found this helpful, be sure to hit that like button, subscribe for more insights, and leave a comment below. What's your first financial goal for this year? I'd love to hear from you. And if you're interested in how global shifts can impact your investments, check out my video on how to protect your portfolio during market volatility. Thanks again for watching. Stay confident, stay informed, and I'll see you in the next video.